I want to share with you today Carlisle Companies and my thoughts on this opportunity. It has some dividends, but it's also got some very powerful total return elements for long-term investors looking for some great opportunities here and some good yield on cost over time. So stick with me and let's look into it. So Carlisle is a company that I've had my eye on for a while. It's certainly one that has a very long history. As we can see here, founded in 1917. It's now quite a large global company. It focuses on engineering, and we'll look a little bit more at those segments in just a second. One of the reasons that I do like this company is their focus on efficiency and sustainability. So if you're looking here, industry-leading engineering process advances, energy efficiency products, trying to reduce some of that greenhouse gas burden of buildings and reduce the end of life processing. So when we're thinking about this, for my mind, a lot of my research work at the university is in the construction sector. And so when we think about energy efficiency, we may not all agree with the need for worrying about energy efficiency in terms of climate change. However, the construction industry, I promise you, is very, very, very much focused on this. And many people buying or renting facilities, or constructing facilities, they're going to be very focused on energy efficiency. Now, there's a couple of key reasons for that. Number one, money. A really energy efficient building is one that doesn't require as much money on a regular basis simply to heat or cool, to keep that building in a comfortable environment. So there's some, real financial reasons why companies are looking at this. Now, companies then like Carlisle are able to come in and provide these facilities for their clients. Now, Carlisle is very much focused on developing innovative solutions. So they have, for example, a range of different products and a range of different construction systems. Now, I do love the focus on construction systems because they provide a very, very strong stickiness to the company's products. So your clients are going to be coming back again and again and also buying not just one, but several elements from this company. Turning to the business quant system, we can see here that the company here by segment and by revenue, they have the interconnect technologies, they have fluid technologies, and up here in, the big, large, outsized part of their business is the general construction materials. So you can see from this that they are very, very much focused on this construction materials. It's a big part of their business, although their expertise in aerospace and fluid technologies also is not to be ignored, in my opinion. A lot of the company's products are also focused on the general building renovation market, but a lot of what they sell is non-cyclically based. So even through recessions and downturns, they'll still be doing some pretty good business. Now we can see here, like many companies, they did experience some challenges in the global financial crisis. We can see the price went from about $50 a share all the way down to $20 a share. But at the same time, the earnings were not slipping too much. The earnings have remained fairly steady, and we don't see big swings, huge cyclic swings that we'll see in other comparable sort of construction focused companies. So there's a much more steady eddy feel to the Carlisle companies here, and I think that's valuable for the long-term investor also. Now, Carlisle, obviously, it's in the name, it's a group of companies. One of these is the Henry Company business, and that was recently awarded by Home Depot the Building Materials Vendor of the Year. And not only is this just general outstanding performance, but it's also about the product innovation. And again, this comes back to Carlisle's leading position in terms of engineering capability, the ability to create amazing new products that will drive energy efficiency for their clients, and also the speed of install is also important. The speed and efficiency of getting their products incorporated into the build and getting that build constructed is important. And so a lot of their innovation is not just on environmental and sustainability focus, but also on those building systems, enabling workers, enabling tradespeople to rapidly incorporate these elements into the build so they've got more time for other things. Now, the fourth quarter results are due in just over a week from now, on the 7th of February. So these are the slightly older third quarter 2022 results. Now, we can see they not only boosted revenue by a massive 36%, but they've also managed to boost their adjusted EPS by nearly 90%, which is quite remarkable. So they've got both top and bottom line results, and when we read through the deck, we begin to see that a lot of this is down to improved volumes. They've been able to raise their prices, so managing the inflationary impacts in 2022. They've managed to do well in terms of that merger and acquisition with Henry, that the company that just won the award. They've had some share buybacks as well. So there's a lot of reasons here why they've managed to do a good job in both top and bottom line results. Carlisle also has a strong balance sheet. They have some debt maturities here, but as we can see, they're relatively small amounts, and they're also due relatively spread out over several years. So these maturities I don't consider to be very concerning at this point. Now in February, I'll be looking very much at the full year results. The third quarter suggestions here for the overall 2022 revenue growth, again in construction materials, quite strong. The weatherproofing technologies, I think, driven by the Henry acquisition there, very, very strong indeed. So I think there's a lot of benefits here. The interconnect technologies also from the commercial aerospace exceeded 20%. And so I think, as we see here, also a lot of backlogs are growing as well, which is also quite positive for the company long term. So let's think about the future. What are we looking at? So we're looking at a company that has grown steadily for many years, obviously over 100 years old from establishment, and we can see post-pandemic a very, very large surge here also in the operating earnings. Now if we look over here at the right on fast graphs as well, we can see a very nice BBB S&P credit rating. Long-term debt to capital is a reasonable 38%. Dividend yield is quite low for me at 1.25%, but we'll have a look at what that means. And we can sort of see that the overall prices here have tracked that orange line reasonably well. The earnings growth, the blue line here is a normal PE ratio over this period of about 18 times, so reflecting slightly higher growth. Now, if we flick this over to the analyst scorecard, how have the analysts been doing? Well, we can see the 2-year forward has been pretty reasonable with a 20% margin of error most of the time. 3/4 of the time the analysts get it more or less right. In the short term, over a 1-year period with a 10% margin for error, the analysts are more or less right or favourably slightly off, where the company beats the expectations, again about 3/4 of the time. So this is it's not a perfectly easy company for the analysts to estimate the earnings for, but they do a reasonable job. Remember to hit subscribe and become a better dividend investor today. So with the fast graphs forecasting calculator, what might this mean? Well, I'm going to look at the 2024 year. I've adjusted the PE multiple here to a reasonable 18 times, so that's what they've exhibited over the last 20 years on average, which I think is reasonable given the overall strength of the company, given the fact that they are a world leader in terms of the engineering solutions, the focus on energy efficiency, and building solutions. So I think that they should be having a PE greater than 15 times, so I think that's reasonable. First of all, let's look at the analyst estimates. So from 6 months ago, 2024, we looked at 23.27 for the analyst estimates. More recently, that's been revised down to 21.84. So a little bit of a weakening there, but not too bad. So a little bit weaker than it was 6 months ago. In the current conditions, I think that's very reasonable. Now, if we click on the 2024, if prices return to the price to earnings multiple and this estimate here for 21.84 is going to be met, then we might expect prices to increase up to about $400 from the current $240 or so dollars. Throw in a little bit of dividend increase as well. That's the total rate of return of about 70%, or an annualized rate of return of about 30%. Now the dividends here, obviously at 1.25%, are relatively small, but if you're planning to hold this for years or perhaps even decades, I think this is still quite a nice holding, and we'll look at why. Switching over to the fast graphs performance. So this is historical performance. We've got a dividend per share. As we can see, this is growing. We can look at the annual growth here, so the dividend growth in percentages. It tends to be single digits in the 2000s, and since about 2010 we've seen quite a few double-digit increases, including the full year 2020 dividend increase here of about 21%. Now, the key thing here, I think, as well for us as well, if we look at the overall yield on cost here. So if it held the stock for 20 years, the yield on cost would now be approaching well into the double digits, now approaching 15%, which I think is quite strong. Furthermore, if we invested in 20 years ago in both Carlisle as well as the S&P 500 index, the compound annual growth rate here for Carlisle would have exceeded that for the S&P, which I think is quite a nice result indeed. Now, of course, individual companies, they do fluctuate more than that index does, but in my mind, that just gives us the opportunity from the right time, I think like now, to actually make an attractive entry into the company. So is this the right time to buy? So looking a little bit further here, in Finbox, again rated as a fairly great company in terms of financial health, which is what we'd expect with a BBB S&P credit rating. Analyst targets here, they have 6 analysts that they're drawing on here, ranging from about $315 to $360 per share. I do think those are a little bit on the high side generally, compared to the current $242 roughly per share. Now, I prefer to go down here, and they've got a range of models that they use. I'm not going to muddle about with that too much here, but just as a very broad perspective, those average models give us about a $324 fair value target. You can quibble about which ones of those we might use, but overall then it would suggest perhaps a 1/3 upside to fair value at the current prices, which is reasonable. That's pretty much actually exactly what we saw as well with fast graphs as well. Some substantial upside there with about a 30% rate of return annualized per year. So I think we're in fairly good shape here for an investment. And look, this is certainly a company that I'll be looking at investing in, and I'll be watching those February results very closely as well. So I've had my eye on Carlisle for quite a while. Late last year, when I wrote about it on Seeking Alpha, I thought the price was simply too high for the quality of the company. I think the price declines now to about the $240 level, is very reasonable for an entry for a very, very long-term buy and hold here. So look, do let me know, what do you think about the Carlisle Companies? Is this an interesting opportunity for you? Be aware of the lower starting dividend yield, but the good strong long-term dividend growth and the overall long-term opportunities for investing in this company. Right, hit up those comments down below. Let me know what you think. Is this a good buy now? Let me know.